All right, so are you ready to dive into this? Today we're looking at the stock market, trying to figure out how to win in this crazy world. Not just survive,
Right.
like actually come out on top. I mean, it's no secret. Markets can be brutal.
Yeah.
It's like a roller coaster. You get on, think it's going to be smooth sailing, and then, bam, you're plummeting straight down. That buy and hold roller coaster can be rough. So how do we navigate this crazy ride? Well, the good news is some really smart people have spent a ton of time trying to figure that out, and we're going to tap into their wisdom. In this deep dive, we've got 4 approaches to unpack. We're going to look at Austrian Economics, value investing,
Yeah.
growth investing, and asset revesting. And you know what's really interesting? These aren't necessarily enemies. They're not all fighting for the same space. In fact, we might find that a blend of these approaches is the real secret sauce. So what do you think?
I think you're spot on. Markets are incredibly difficult to predict, and you know why? Because they're not just numbers on a screen. They're driven by people, by human beings with all our emotions and reactions.
Right, and that's where Austrian Economics comes in, doesn't it? It's not just about crunching the numbers. It's about understanding the human side of things. Like I was looking at this article from the Quarterly Journal of Austrian Economics, and it really emphasizes how markets are just this constant interplay of individual choices. You know?
Exactly. Austrian economics helps us see the bigger picture. It highlights how things like government actions, like setting artificially low interest rates, can really mess with the natural flow of the market. And that can lead to those crazy booms and busts we see.
Oh, so like with asset prices, like what happened with housing back in the mid-2000s. Low interest rates made borrowing super cheap. Everyone jumped into the market. Yeah. And prices just went nuts.
Precisely. Austrian economics gives us that crucial context to understand what's really driving those market movements.
So it's less about picking individual stocks and more about understanding the whole market environment. Got it. But what about investors who are dying to pick winners? Where do value investing and growth investing fit into all this? Those seem like 2 totally different philosophies.
They are. Value investing is like the bargain hunter of the stock market. Always looking for those hidden gems, the companies that the market is undervaluing. They dig deep into the financials, looking for things like a low price to earnings ratio.
Hold on, what's that? I hear that term all the time. Price to earnings ratio. What does it actually mean?
Sure. Basically, it tells you how much you're paying for every dollar of a company's earnings. So a low PE ratio could mean the company is undervalued compared to its potential. Value investors also look at things like strong cash flow, a low price to book value, all signs of a company's real worth.
So it's like finding a vintage Rolex at a flea market. Way more valuable than its price tag.
Yeah.
But isn't there a risk of falling into a value trap? What if a company seems cheap for a reason? Like maybe its best days are behind it?
That's a great point. Not every cheap company is a good investment. Value investors need to be smart about it. They need to understand why a company's undervalued. Thorough research is key. But when it's done right, value investing has a really strong track record.
Okay, so value investing is like the patient detective. Yep. Carefully examining all the clues. But growth investing, that seems like the opposite, right? It's all about potential, betting on the future stars.
You could say that. Growth investors care less about a company's current value and more about its future growth prospects. Like, think about Amazon in its early days. The price was always high PE ratios. But investors who saw the long-term potential were rewarded big time.
So growth investing is like being a venture capitalist. You're taking a calculated risk on a company. That could disrupt industries, even change the world. But how do you separate genuine potential from hype? Are there red flags growth investors should watch out for?
Absolutely. One thing to look at is the management team. Are they visionary leaders? Do they have a clear strategy for growth? What about the competition? Are they in a fast-growing market with few competitors? And most importantly, is their product or service truly innovative? Is it likely to capture a big chunk of the market?
So it's not just about chasing the latest fad. It's about understanding the business and its long-term potential. But high potential often comes with high risk.
Exactly. Growth stocks can be more volatile. There's always a chance those expectations won't be met. It's not for the risk averse.
Okay, so we've got our bargain hunters and our future-focused investors. What about asset revesting? This one sounds totally different. More dynamic, like riding the waves of the market?
It is. Asset revesting is all about adapting to the ever-changing market conditions. It relies on technical analysis, looking at charts and patterns to identify trends, then deciding when to buy and sell.
So you're not just buying and holding. You're constantly checking, seeing which assets are hot, which are not. Like a surfer catching those waves.
Yeah, that's a good way to picture it. Asset revestors are trying to ride those upward trends and avoid the crashes. It's definitely a more active strategy.
Sounds like you need to be paying attention all the time and really understand those technical indicators. But wouldn't it backfire in a bull market when everything's going up?
It could, yeah. If the market keeps climbing, all that buying and selling might actually make you miss out on some gains. One of our sources, the Asset Revesting article, points that out as a potential downside.
Okay, so we've got these 4 approaches, each with its own strengths and weaknesses. I'm starting to see how they could work together. But it's a lot to take in.
It is, but remember, the goal isn't to master all 4. It's about understanding the basics and seeing how they can complement each other. So let's compare them a bit more directly.
Okay, compare and contrast time. Let's start with Austrian Economics. We talk about how it gives you that big picture view, but how does that actually translate into investing?
Think of it as a lens. It helps you see the market more clearly. Like you can spot bubbles forming, recognize when government policies are messing things up, understand the risks of fiat currencies.
So it's like having this extra layer of insight, an awareness of the forces driving the market. But it doesn't tell you which stocks to pick.
Right. It's more about managing risk and understanding the overall economic landscape.
Got it. Now, what about value investing versus growth investing? It seems like they'd always be clashing.
They do have different focuses, but they can absolutely coexist in a portfolio. Value investing provides stability because of the emphasis on undervalued companies, companies with solid fundamentals. Think of it as the foundation of your portfolio.
Okay, so that's your base, your steady earners. And then you add some growth investing for excitement, for the potential of those big wins.
Exactly. A growth investor might pay a premium for a company that's disrupting things, developing a groundbreaking technology. They're looking at future potential, not just current value.
But those are also the ones that can crash and burn. If the growth doesn't materialize...
True. That's why diversification is so important, especially with growth investing.
And where does asset revesting fit in?
Asset revesting adds agility to your portfolio because it's focused on riding trends. It's like having a tactical team that can jump on opportunities and minimize losses when things go down.
So it's the quick strike force, always adapting. I'm really starting to see how these pieces work together, like assembling a team with different skills.
Precisely. You have your core holdings, the value stocks. They provide stability and income. Then you have your growth allocation, the potential stars that could bring big returns, and then the asset revesting component to handle short-term volatility.
That's a pretty compelling picture, but I feel like something's missing. We talked about Austrian economics and the risks of fiat currencies. You mentioned gold as a hedge. Does that fit into this blended strategy?
It definitely could. One of our sources, Bob Kirtley from goldprices.biz, argues that fiat currencies are inherently unstable because they're not backed by anything tangible.
Which makes sense. Their value can swing wildly based on government policies in the economy. Look at how inflation has eaten away at the dollar. So if fiat currencies are risky, what's the alternative?
That's where assets like gold come in. Gold has held its value over time. It's a safe haven during tough times. It can bring stability when other assets are all over the place.
So it's like insurance for your portfolio. It might not make you a ton of money, but it can protect you during market storms. How would gold fit into our model portfolio?
It would probably be a smaller allocation, a strategic holding, to protect against those big macroeconomic risks. Think of it as ballast, helping to steady the ship in rough seas.
I like that. So we've got our value stocks, our growth allocation, our asset revesting component, and now some gold. It's starting to look like a really solid approach. But how much of each? That's where it gets tricky right now.
Absolutely. There's no one-size-fits-all answer. The right mix depends on you, your risk tolerance, your time horizon, your goals.
And probably your own beliefs about the market and the economy. Some people might want more gold if they're really worried about inflation or fiat currency risk.
Exactly. It's about aligning your portfolio with your understanding of the world and your comfort level with risk.
But this blended portfolio idea is really interesting. Instead of putting all your eggs in one basket, you're diversifying, hedging your bets against uncertainty.
That's the key. You're acknowledging that no single approach is perfect and that combining different perspectives can make your portfolio more resilient.
It's like having a team of advisors, each with their own expertise, helping you navigate the market. It's like you're embracing the complexity instead of trying to oversimplify things. But this whole conversation has got me thinking. We talked about gold as a hedge against fiat currency risk. But what if? What if there was a way to combine gold with the flexibility and innovation of crypto? Like imagine a gold-backed cryptocurrency.
Wow, that's a fascinating idea. And it's actually gaining some traction. It's not totally out there. A gold-backed crypto could be a bridge between traditional safe havens like gold and the world of digital finance.
It's like the best of both worlds, right? You'd have the stability of gold,
Yeah,
but also the convenience and accessibility of crypto.
exactly. But there are challenges, of course. Like, how would the gold backing work? How would it be audited? Could you easily exchange the crypto for physical gold? And what about regulation? These are all tricky questions.
Sounds like we need another deep dive
Yeah.
to really explore that. But it's exciting to think about the possibilities, these innovations that could change everything.
It really shows how dynamic the financial world is. Just when you think you figured it out, something new comes along and shakes things up.
I love that. It keeps things interesting and reminds us to keep learning. Well, this has been an incredible deep dive. I feel like I have a much better grasp now on how to approach the stock market with clarity and purpose. It's not about finding that one magic formula. It's about understanding the tools and strategies.
And crafting your own approach.
Absolutely. It's about becoming a thoughtful investor, someone who understands the market and makes decisions aligned with their values and goals.
So to our listeners out there, keep diving deep, keep asking questions, keep learning. The stock market can be tough, but it can also be rewarding, especially when you approach it with a curious mind and a well-defined strategy. Thanks for joining us on this deep dive into investing. Until next time, keep seeking knowledge